Hello and welcome everyone to today's CREtech Talks, financial and operational perspectives to assist startups during the pandemic. I'm Ashkán Zandieh, Chief Intelligence Officer at CREtech, and I will be your host and moderator today. We'll be hosting our new limited series CREtech Talks every Friday starting at 12 noon Eastern Standard Time for the next several weeks. The goal of our events is to check in weekly on the state of real estate tech and the built world in the wake of the recent pandemic. In the coming weeks, we are planning sessions around real estate tech M&A, perspectives on the European venture capital market, the state of accelerated innovation in the pandemic era of real estate, and so much more. If you have any questions, suggestions, topic ideas, or more, please contact us via Twitter at @DiscoverCREtech or via email at research@CREtech.com. While everyone is logging in and getting set up, please let me update everyone on a few developments from CREtech. On April 14th, we will be hosting a webinar with our friends at Freshworks on automation and engagement for owners, managers, and real estate professionals. On April 21st, join us for CREtech Virtual Demo Day, where you will hear from 6 of the most exciting and innovative technology companies and their innovative solutions transforming commercial real estate. And lastly, and of course, we hope to see everyone on September 30th for CREtech New York. To find out more about any of our events, please check us out at CREtech.com/events. That's CREtech.com/events. I see we have a crowd already gathering, so let's just get started. In the midst of the recent pandemic and global economic crisis, real estate technology startups are faced with extraordinary financial and operational pressures. Today, we will hear from 3 of the most experienced business leaders in banking, legal, and accounting, offering their insights on how startups can navigate these incredibly challenging times. Please join me in welcoming our esteemed group of panelists. Joe Theis of Goodwin. Joe is a partner in Goodwin's technology companies and capital markets practice, where he concentrates in general corporate and securities law and has significant experience in capital markets transactions, mergers and acquisitions, venture capital financing, SEC compliance, and corporate governance. Matt Barbieri of Weiss & Co. Matt is a partner in charge of the Media Technology and Life Sciences Group. His focus ranges from startup inception to seed financing, helping to develop companies and continue their organic growth. Dan Allred of Silicon Valley Bank. Dan is a senior market manager for Silicon Valley Bank, leading the bank's technology practice in Boston. In his role, Dan and his team partner with innovative companies, innovating in enterprise software, hardware, consumer tech, and fintech. Gentlemen, welcome. Let's just dive into it. So there's a lot of confusion and misinformation out there about government-sponsored payroll protection plan. We've been talking to startups and the heads of nearly every real estate tech company, and we've been speaking with them, and their heads are spinning. So let's just kind of jump into this. What are you guys seeing in the market? What are your clients doing to survive and thrive in today's market? What's going on?
Yeah, you know what? I'll kick off, Ash. I appreciate it. I think it's important to go back to, the beginning of this kind of process and think about what it takes to get a general, legislation or sweeping legislation change like this through. And a lot of the confusion came because of the way information was leaked, so to speak, and the way we were getting it. So on behalf of the banks, I know that you're taking a beating at this point. So I'll kind of maybe lend a little bit of color to that process or understanding it. In the beginning, the SBA was clear that the loans were going to be processed directly through the SBA, and it was going to exclude all the lenders. So everybody was wondering, okay, how's this process going to work? How are they going to get through this with this much, volume or expected volume with all our clients meeting this? And it was almost, it was pretty rapid change that they decided to include the banks. So then these banks who probably don't have a significant amount of experience in dealing with the SBA, nor a process set up to handle this kind of a volume, are now thrust into this process. So, so there was a lot of, I would say, confusion that was generated just from that before the program was even really fully understood.
Yeah, and I'm happy to pick that up. First of all, appreciate the invite, Ash, and Matt, appreciate the air cover there with opening that up the way you did on behalf of the banks.
I got to help a little.
It's been a rough couple of weeks, and certainly it's been hard for everybody. There's a public health crisis, and there's a very real financial crisis as well. So, you know, that alone would have made the last couple of weeks tough. The process that we're all trying to put in place and the infrastructure we're all trying to put in place to help these companies with access to the PPP, particularly, has been really challenging. And, you know, a lot of expectation and an overwhelming demand, you know, which is part of the reason that the government agency needs to use the banks, you know, is to distribute some of that. But even for each of us, it's certainly been overwhelming, and it's been a tough process. That said, we're all making some progress and starting to process more and more applications. But there's still unanswered questions for sure, including likely many of the questions that attendees here have today. But we'll get into that. You know, in terms of what we're seeing from our clients, just to take a step back from just the CARES Act and just the PPP, I mean, we're basically seeing everyone focus on cash runway, right? And making sure that just primarily we're working with technology companies and many of those venture capital backed companies. So most of them are losing cash, right? Most of them are burning cash and focused on product development, market development, and therefore, you know, designed to be cash flow negative. So they're all focused at this point on just how much runway do they have and what can they do to maximize that runway and make sure that they're able to get through what will certainly continue to be a turbulent economic cycle and show progress in their business and support valuations and that type of thing when it's time for them to raise money again. So as we're talking to our clients, they're doing revenue sensitivity analysis. They're also, most of them, making some kind of expense cuts just to make sure that they can prolong the life of the cash they have. And when we're talking to equity investors, venture capitalists, and otherwise, they're doing the same for their portfolios and sort of looking at, you know, which ones are in the most dire situation and need to raise money soon, and how they can go about shoring up those resources for those companies, and then looking at those who, you know, have a longer runway and just making sure that, you know, they're making prudent decisions, cutting as they need to, but not cutting too much. And then on top of that, you're overlaying just sort of what market do you play in, how are your customers performing, you know, what's the impact going to be overall as you think about that.
Yeah, Dan, I think that's all kind of good context for people, and we're seeing the same thing with our clients in terms of a focus on cash conservation. You know, I think everybody is affected by this crisis in one fashion or another. It could be because you know somebody who's sick or somebody who's a healthcare worker is in the front line, or your business is impacted. Some businesses are impacted more than others, but they're all impacted. Even if they haven't been impacted significantly yet, a lot of our clients are doing some scenario planning in terms of what happens if the crisis doesn't turn around, you know, by Q2 or Q3, and then kind of what does that look like? So there's a lot of scenario planning from a cash conservation standpoint as well. And, you know, it's just a harsh reality that, you know, our clients find themselves in, kind of having to deal with this. One other sort of additional kind of layer of context I'll add on the SBA program is, you know, from a legal perspective, you know, I think the SBA kind of rules and regulations, somebody recently described as Byzantine, and I think that's a pretty good word to describe it. If you're a tech company, if you're venture capital backed, you're private equity backed, that's a class of companies that has historically not accessed SBA programs. Now this program is available to some of those companies, and we'll get into those details later. But people are looking at some of these rules and regulations and applying it to a typical VC-backed company and asking really good questions around eligibility. And many of those questions are unanswerable because the guidelines are unclear, they are gray, and the SBA just hasn't had to answer some of these questions before because these types of companies haven't come before them to determine eligibility. And so there's a lot of gray. There's very few bright lines. There's very few black and white answers. There's gray. And I think what we keep focusing clients on is that from a legal perspective, they have to make these certifications in good faith, and they can't make any knowingly false statements. And each company is going to be a little bit different in kind of what they do to get to those comfort levels. But we are in a world of gray and trying to be reasonable and acting in good faith, and that's uncomfortable for many of our clients.
So I'll leave it there for a second, but take it back a little further, actually. So what specifically is the CARES Act, and how does it specifically help small businesses like real estate startups and entrepreneurs? And Joe, I'll start with you, because you being the attorney in this sector, I could just imagine all the companies that are just reaching out, startups, enterprise, corporates. You just imagine the nature of the conversation you're having. Like how has the CARES, like what is it and how is it helping companies specifically?
Yeah, sure. So as somebody who's been an expert in the CARES Act for all of 15 days, I'll try to answer that question. So, really kind of at a fundamental level, the CARES Act is a major part of the stimulus program that, Congress and the president signed into law to help people deal with this crisis from an economic perspective. And I think as it relates to, technology companies, there's a handful of different things in there that are potentially helpful. The piece of the legislation that's received the most, I think, airtime is the Payroll Protection Loan Program, which was a $349 billion program designed to help small businesses protect payroll. That's the name of the legislation. And we'll get into more details later, but at a high level, you take a look at your kind of average sort of payroll costs over a 12-month period, you can borrow 2.5 times of that amount. It's a pretty cheap loan. It's a 2-year term with a 1% interest rate. It's guaranteed by the SBA, so there's low risk for the lenders. And depending on how you use that money, you can get most or all of that loan forgiven. And that's really kind of, I think, the goal for Congress was to get money into people's hands quickly and then not have them have to pay it back, or if they do, pay it cheaply. There are other aspects of the CARES Act that could be helpful to other companies. So for example, there's some payroll tax credits that you could potentially apply for. There's also the ability to defer payroll tax. So in other words, when you think about sort of the employer portion of payroll tax, rather than paying that to the government, you simply don't pay it. So it's a way to go back to conserve cash, like we were talking earlier, and you can defer that into 2021 and 2022. You can't do that and take the loan. So there's some choices for people to make. And then, there are other aspects of the CARES Act, but the one that I'll mention, which is sort of still to come, are these emergency loans to mid-sized businesses, which really aren't kind of, there's not a lot out there on that yet. And that's probably not going to be as relevant to your sort of classic kind of tech company, venture capital, property tech company. But that's another big piece of this that's probably coming down the road.
So for those of you that have recently joined and you have any questions, please click on the Q&A button on the bottom of your page if you have any questions for any of our panelists. I see that a few questions are coming in, and while we're on the subject of the CARES Act and PPLs and others, I see that our CEO and our dear friend Mike Beckerman has a question. Do you think there's a chance that PPLs will be, one, funded with more capital, more dollars, and then 2, extended beyond the 2 months? And I'll kind of throw it up there for everyone. Matt, Dan, Joe, if you want to take that.
I mean, I think we're already seeing that there's a lobby to add another $250 billion to it. The people that we speak to and the sources that we have pretty well indicate that there will be more funding for this. Not certain whether this is going to extend beyond the 2 months. That remains unclear. But I think that what's been done here is setting up the platform to be able to disperse funds through a program like this. And should further stimulus be needed, it should hopefully be able to be done in a more streamlined manner, right, for the second go around. And I also think it's important that we spend just a few minutes speaking about the EIDL program, the Emergency Injury Disaster Loan Program, which existed before the PPP. It was a 7A program set up years ago. And there was a lot of press, or there still is a lot between, which loan do I choose? Do I choose the EIDL? Do I choose the PPP? Does one kick me out of another? And so just to prove how fluid the news and information about these programs is, I just received an update about the EIDL program. So I'll tell you what it was and what it is as of about 10 minutes ago. So the EIDL program was one that you show up for, and we called it like the real economic distress loan. If you were closing your doors, you'd come in and get the loan. You would get $10,000 within 3 days of applying for the loan, and that money would be a grant, right? The remaining loan that you kept would be over 30 years. So it would amortize over a 30-year period, and you could extend the runway, and it would be a loan of up to $2 million. What I've learned in the last 10 minutes is they're limiting that loan to the number of employees you have times $1,000 with a cap of $10,000 because the money in the fund has been expended for the EIDL program. So while you would originally apply for the EIDL and refinance that into a PPP loan, that doesn't seem as plausible now.
And then just to kind of piggyback off that, maybe this might be a legal / banking question, I'm not sure. But a question came in from a viewer saying, I own 3 different LLCs, none are affiliated. Can I apply for the economic injury disaster loan for each one? Or is that just a legal nightmare to go through?
Well, the guidance is to apply by FEIN. So my theory on that would be you would apply 3 separate times.
3 separate times, okay.
Yep.
Yeah, and we have clients. I agree, Matt. We have clients that are doing that exact thing for their application. I think the thing to keep an eye on is the affiliation rules. So maybe just to touch base on that for a second, there's this concept in the SBA guidance and rules, and this goes back to it being Byzantine, that you may be affiliated with other entities, and where that becomes relevant is particularly around whether or not you're eligible. So if you're in industry classification where you have to have 500 or fewer employees, you would need to aggregate with each of your affiliates to confirm that you're under that 500 employee limit. And so, we do have clients where they are affiliated with other companies. All of the companies are under 500 in the aggregate. So each of them can apply, but there's going to be disclosure about the other affiliates in each applicant's application.
Mm-hmm. And can I just speak to one other aspect of the CARES Act? I mean, I think we're probably going to mostly cover PPP today, or at least that's going to be a recurring topic. One of the other helpful pieces of that came from that law is relaxation of troubled debt restructures for banks. So there is a, not to go too deep into this, but basically there are certain things that banks can't do without charging off the loan. And one of them is a lot of guidance around troubled debt restructures. And you can imagine at a time like this, when companies are trying to conserve cash as much as possible, it's very advantageous if they can defer payments especially on amortizing term loans. We have actually taken advantage of that provision around the relaxation of accounting principles around troubled debt restructures, and try to, as much as possible at scale, provide relief around principal payments on most of our amortizing term loans for venture capital backed companies. So for that profile of company that is likely burning cash. that has been that's been a huge help to our borrowers, and honestly, it's been good for us as lenders in terms of being able to sort of do something at scale that's really impactful for our client base, but not have to do it on a case-by-case basis, which, as you can imagine, is crushing from a time load or from a time standpoint, and sort of return on investment standpoint. So that's been one piece that hasn't been talked about as much from the legislation, but has certainly been helpful. And
I'm gonna bother you. I got to jump in because I'm wondering where I see most clients getting tripped up here is if they've got an existing debt arrangement, they've got a limited on future or further indebtedness, right? So that's the clause that I think I'm talking to clients about, that they're scared. How does the PPP interact with that clause in the loan agreements that they already have?
Yeah, I can, I can't speak for how every bank is approaching that, but we are, to the extent that we have provisions in our loan agreement that would prevent someone from, say, applying for a loan like this at another bank or having it funded by another bank, we're freeing them up to be able to do that. Now, for the most part, they're applying with us, right? Yep. They're existing bank, but to the extent that they, there's limitations on like additional banking relationships or deposit relationships or whatever, we're making sure that they're free for that if they're pursuing a loan elsewhere.
Good.
A question came in actually regarding that application process. The question is, can you apply it through multiple different banks? Assuming you can only take one loan if approved. Could you, or is that just ill-advised?
I'm far from an attorney, and so I'll let Joe chime in here too. I would feel like that would be not advisable from my standpoint. If I've had clients ask me that, saying they were basically going to set up a horse race, get this bank, this bank, this bank an application and see who gets it in first. There's been communication that the SBA is highly concerned about fraud. And I just feel like it would be something that would be problematic. And so, Joe, I don't know what your thoughts are on that. Those are my thoughts.
No, I agree with that. I think that would be suboptimal. I think reality is people probably are doing that with the best of intentions because they're desperate for the money. And just kind of given how this thing has been rolled out, you sort of can't blame them. But I think, as Matt said, that would not be the best advice. One slight sort of wrinkle there is, many banks ahead of taking applications are asking you to indicate interest. I know, Dan, you guys did this initially, and there are still some banks that are in that indication of interest period and have not opened up their application. So I think indicating interest to one bank and pursuing an application with another is different than pursuing two applications with two banks. And so I think that is something that I think people should do, because you don't know with these banks that are just taking indications of interest, you don't know when they're gonna open up. And Dan, I don't know if you have a view on that, but I do think that's a different fact pattern.
I think you guys addressed that well. I don't really have anything to add. You certainly don't want to have you don't want to be in a position where you have two loans to the same company. That there's obviously going to be penalties for that. I wouldn't even set yourself up to have two applications.
Yeah, and to that, most of the people that we've been talking to, they're entrepreneurs or VC-backed startups, and they have a sense of urgency. To our earlier point, this, everyone's trying to, maximize, how do you maximize your recovery, cash flow process and all that. And so there's a rush to preserve capital. And in doing so, there is a rush for application. So if you are a VC-backed startup, should you, and you're going through this process now and just considering it, should you be rushing to apply? Is there a need to rush, or can you take your time in that process?
It's a loaded question.
Yeah.
That's how we do it over here at CREtech.
Should has new meaning right now.
Rush. Don't sacrifice accuracy in the application. Push the bank to ensure that they're doing what they can with the SBA to get you an origination number. Hard to advise. I would say, yeah, this is high priority if you're a business owner or operator.
Yeah. Yeah, and I would just say, look, everyone is rushing. So, almost regardless of how we answer this question, I don't know that it's going to change the behavior too much. I think that the problem is being able to actually ingest all these applications, right? That's where the bank is struggling. That's where the banks are struggling. That is where the SBA will likewise be struggling. I think the key is, have everything ready, for your application in terms of how the calculation is going to be made and all the things that are going to matter, which are going to be around number of employees and retention and that type of thing. Just have your documents prepared. And most of the banks have done a really good job of, saying, have these documents ready to refer to and load as you apply. So, don't skimp on accuracy. You're representing that this is true in an application that's going to a government agency. So, take that very seriously. But certainly everyone is rushing. It's not a complicated application, actually. It's just a matter of sort of getting it into the system and getting it into the production cycle that flows through a bank, but also flows through a government agency. So.
Let me pick up on one other aspect of the should. So, I think a hot debate, sort of particularly coming out of like Monday partner meetings, which venture capital and private equity funds have, is should we be supporting our companies applying for these loans? And the should that they were focusing on there was really more around, are these loans, is this program designed for us, or is this program designed for more mom and pop, restaurants and shops and in other parts of the country, as opposed to sort of either well-financed or companies who have deep pockets around the table. So I think that has been a hot topic this week, particularly coming out of Monday partner meetings. I think certainly kind of for top tier venture capital funds, I would say that there's been a cooling on this program, not a warming, so that, companies, venture funds may be supporting certain of their companies in their portfolio, but certainly not all of them, because of this view that, really maybe it's not designed for them, and so we shouldn't. And I think the should kind of falls into two camps. One is sort of a political view, which is, just morally, these aren't for us, we shouldn't apply for the money. The other is more of an optics view, which is in hindsight, 2 years from now, people are looking into this program and they find that a bunch of the money went to venture capital backed companies and not towards, kind of mom and pop restaurants. What does that look like 2 years from now? And I think that's a very real concern from a PR perspective for many of our clients, both companies and venture capital funds.
That's really interesting. And so while we're on that subject of access to capital, access to information, I'm going to open a poll to our viewers. Anyone that would like to receive more information on banking, accounting, and legal, I'm going to open up a poll. Feel free to just, chime in, and we'd love to, help support all entrepreneurs, startups, and companies that would like to receive any and all information from us. And I see, wow, polls underway. Wow, already 10 plus responses already within seconds. Wow. 50, wow, it's climbing already. Wow. Anyway, I'll leave it at that. The super shock there.
I think just to expand a little bit just with Joe, because I've had similar discussions with the venture capital community about whether or not this is applicable for those companies. I fall back. I haven't decided yet, to be honest, and I think it's a theoretical question. If we think about the spirit of the law and keeping people employed, some of my worry is that, if you're a company that was in need of a financing and now you're in dire straits, this could be a big problem for the company, and it could actually have a negative impact by not receiving this funding, and you're going to have to lay people off that are going to clog the unemployment. Wow. So there is thought to be had around the status of certain companies within the portfolio, and whether or not they're raising around in a time of weakness, right? I mean, raising around right now, I'm not jealous of anybody that has to go raise around right now, or very few companies that,
For sure. Yeah. I mean, you know, I think almost any company could probably make the argument that they're impacted, you know, and it becomes really a question of who's impacted the most, right? And which jobs are the most at stake. And, you know, it's been really interesting for me, you know, just talking to our clients and seeing incredible urgency around these conversations. But, you know, some of these are startups with, you know, just not a lot of money in the bank. And then others are well-financed venture capital-backed companies with, you know, multiple years of capital in the bank, and they're all pursuing this with the same, you know, sort of urgency. And, you know, from where I sit, it does look like one of those groups, you know, sort of was more in mind when people were voting on and drafting this legislation. But, you know, there's, you know, anyone can make or probably all of these founders and CFOs and CEOs can make the case that their companies are impacted, right? So.
I see a question came in regarding, so we've been talking about companies and employees. An interesting question came in regarding the PPP and a staff of 1099s and independent contractors. Any insight around that?
Yeah, they're out.
Yeah, they're out. Okay.
They're out. It's clear as of now, at least they're out. They have to apply on their own, and they would apply for their own PPP loans starting today. But as you can imagine, just as the banks weren't ready on April 3rd to process the new PPP loans for the businesses, I'll leave it to Dan whether or not, you know, you're ready to begin receiving applications for sole proprietorships.
No, I don't think. Yeah,
I don't think anybody is.
You said it well. Yeah, I mean, we're still playing catch up from the first wave, right? And trying to make sure our pipes operate correctly and we can process these apps.
Yeah. And another
questions, just to clarify that, I've been asked questions a bunch from clients saying, well, I have something that looks like an employment contract. Can I pretty please include them? And it's clear they're out. So just, you know, I don't think this is a loan where you want to try to game a system. I wouldn't advise that. I would say there's going to be scrutiny around this on the back end. Traditionally, the SBA loans, clients have walked from them because of the level of scrutiny. I think people might be getting a false sense of hope that, you know, wow, this was so easy, that it's going to be easy on the forgiveness side. I'm just fearful that it's going to be stricter than people might imagine it's going to be.
Yeah, actually, another question just came in from a participant, from a viewer. Have you heard any updates on what the processing time is on the EIDL programs?
EIDL is in a mess. That's the one I just got the email about. The New York Times reported today at around 11:45 that the EIDL process is no longer funding the $10,000 within 3 days. The loan amount is no longer $2 million at a maximum. It's capped at $1,000 times the amount of your head count with a cap of 10, which would mean the loan is capped at $10,000. That's a significant change. The program was funded, I believe, originally, don't quote me on this, because I wasn't spending a lot of time on EIDL, to be honest. We didn't have many clients that fit the profile. I think it was funded with $7 billion, and it's the program is exhausted.
Dan or Joe, you want to jump in on that, or?
Matt, I don't have anything to add on EIDL, but I would say on PPP, you know, the turnaround times and processing times are very much, you know, sort of black box at this point as well.
Yeah.
I think it would be helpful, Dan, if you explain a little bit, you know, the process at the bank, because I think clients don't understand that. Like, they're talking to you and they're like, it's in. You know, what am I, right? There's a whole process after you that I think it would be good if people understood a little bit to kind of.
Yeah. So, you know, the banks are essentially an administrative layer, you know, and and sort of a KYC layer, you know, for this process, which is, you know, certainly a huge help, you know, for the government putting this into place. So, you know, when the app comes in, we've all stood up, you know, basically new departments that didn't exist before to look at these apps, to review versus all the information we have on file, much of which is our own KYC, right? And just to certify that, from a know your customer standpoint, we can sort of sign off on the application. And then it's being, if you go to SVB's website, you'll actually see a schematic of this. But it then goes to, the SBA for their review, their processing, their acceptance or rejection, and then starts to come back with, if it's accepted, with the guarantee number, and starts to put in place the process by which the loan will be funded and guaranteed under the PPP program. So oversimplifying that, there are many more steps, but, like I said, you can go to our website, and I'm sure other banks, and see sort of that, a schematic of what that process looks like. But, at least at this point, we don't have great details on sort of what happens from a timeline standpoint in terms of the turnaround at the SBA.
So go ahead, Joe.
And Dan, are you still, or do you recommend sort of people in terms of where they go for their lender? Does it make sense to start with an existing relationship rather than start fresh with a new bank?
I think it does, and the reason is, like I said, really a huge part of the value add we bring to the process is the KYC we have to do on clients anyway. Right. So I think it makes sense to apply through a bank where you're already a client. Now, obviously, not all banks are doing this, so some companies are having to figure out other options, and many banks are setting up new client relationships and accepting applications, and including us. There's a lot of urgency around the application, so that means there's a lot of anxiety if you are one of those companies who's trying to scramble for sort of a new banking relationship, because you pretty much have to go through a KYC process to apply. Yep. So it's like becoming a new client.
I think just maybe one little tidbit for people: if you are in a situation where you don't have an existing relationship, or you are looking to go elsewhere, just something that we've seen anecdotally is that, I'm in Boston, so particularly in New England, the community banks that you may have a history of doing SBA loans seem to be better at bringing on new clients. So, whereas you might think, I'm going to go to a large established institution that I've never dealt with before, I would say, at least anecdotally, that's probably not a good idea. And if there's a community bank or a traditional SBA lender in your area, that would be a good place to go if you're going for a new relationship.
Yeah, and I think that's great advice. I think the reason that the community banks are maybe doing better with this is, it's a manual process versus any bank that's, sort of has a lot of customers. We've all had to build a centralized process to be able to do this at scale, which ultimately will be the right thing, but it's all been, sort of hurried and rushed to set it up. So it's just, it's not working as well as it should. Whereas, I think these community banks are sort of used to doing it on a more manual basis. And if you've got the access, it's working. Many more messages like what Joe just said, and maybe they'll be overwhelmed as well. I mean, we'll see. But I think you're right. Where there's been some success, it's been with the community banks.
Yeah, and so seeing that there's 20 minutes left, I really want to get into the audience Q&A. So the last question I'm going to ask, it has to revolve around venture capital. So this is going to be the last question I ask before we jump to audience Q&A here. So jumping back to who's eligible and who's not, companies that have relied on venture capital, are startups that have raised VC, are they free and clear as long as no investor owns more than 20% of their company? And I'll throw that up to you guys. Yeah.
Yeah. Everybody else steps back on this one. So there's really two different concepts here, and they are getting mismatched a lot. So I'm glad Ash asked the question the way he did. there is a question of whether or not you have any affiliates. And again, if you do have affiliates, that's not in and of itself an issue, but it does mean you have to aggregate with those other affiliates for purposes of determining eligibility. And so just to give an example, if you are an affiliate of a venture capital fund, you would have to aggregate yourself with all other portfolio companies that venture capital fund is an affiliate with. So you could be looking at a massive portfolio of companies that have nothing to do with your business, and it wouldn't be hard for particularly for a established VC fund for that to result in more than 500 employees across those affiliated portfolio companies. You'd be out of the box. That issue affiliation is actually totally separate than the 20% test. I'll come back to the 20% test in a second, but that has to do with some questions in the application. The way that affiliation works for purposes of these loans is if you own a majority of a company, you are an affiliate. That's sort of like a do not pass go sort of standard. But as a minority stockholder, even if you owned very little of the company, it really doesn't matter how much you own. If you're a minority stockholder and you alone as a stockholder or as a director of the company have the ability to block certain kind of day-to-day operational controls and provisions of the company, then you are an affiliate. And so, for example, protective provisions that are okay are things like you can have a block on a sale of the company, you can have a block on a financing. The SBA has said that those sort of go to the value of your investment and aren't indicative of day-to-day control. The types of provisions that are indicative of day-to-day control relate to things like incurring debt, paying dividends, changing compensation for employees. So if you're a minority stockholder and you have blocking rights in your investment documents where the company can't do those actions without your consent, you alone, then you're an affiliate. And it doesn't matter whether you own 1% or 40% of the company. That's the way that it works. This is why there's so much sort of heartache in the VC community, because standard investment documents have a lot of these types of rights in them. And to the extent a single stockholder has the ability to block those provisions, you have this affiliation issue. There is the ability to, quote, solve that affiliation issue. So you can go to your investors and ask them to give up these rights. And I'm spending hours of my day having this conversation, as are everybody else that works, in the tech and the VC space, is having these conversations with investors to get them to give up these rights, and many of them are. So that's the affiliation issue. The 20% test is its own thing, and it has to do with the application itself. So in the application itself, the applicant has to certify certain things are true for itself and any 20% owner. And so, for example, you have to certify that your 20% owner hasn't gone through a bankruptcy proceeding. You have to certify that your 20% owner or any entity it controls hasn't borrowed money from the SBA or other federally guaranteed loan and defaulted on that loan. And so that's where the 20% standard comes in. It has to do with a few questions in the application. And some people have affiliation and the 20% owner, some have one or the other, but they are two different concepts that you have to deal with as part of this process.
And Joe, back on the affiliation, are you seeing scenarios where you're being asked to provide a legal opinion as part of an application process?
So there's a couple of banks out there that have floated that idea. That has not sort of taken off or become widespread, and I'm not even sure if those banks are still looking for that.
Yeah.
I will say, not just in a self-interested way, but just in a very real way, there is no legal opinion to give, because you're talking about statements of fact, not principles of law, and there's no clear guidelines. And we've had conversations with all the leading tech firms. There's been some great collaboration on the law firm side with all the big tech firms that we're talking almost every day, and we're all in the same boat here. There is no opinion. It's really a statement of fact. And it's also important to remember that what you're certifying, again, it's not black and white. You're certifying good faith, you're certifying, there's no knowingly false information. And you're doing that on the basis of guidelines that are very much gray. So you're really asking yourself, is my position reasonable? Not, is it legal or not legal? It's a very different standard.
Yeah, no, great point. Great point.
So I see we have 10, 15 minutes. I really want to get into the audience Q&A. So for our viewers, if you have any questions, please click on the Q&A button on the bottom of your page here. And I'll start with a biz dev question that came in. Many startups are struggling because, and I guess this is for you, Matt. Many startups are also struggling because they are being told that this is not the time to be charging for their products and services. But that only puts them further in the hole. Any advice on how to approach biz dev in this environment?
So the way that I'm approaching biz dev in this environment, and that's a loaded question. I don't know whether you could charge for your product or not. I don't know where you are. I don't know what you're providing. So I could provide more color if I knew more. We've taken the approach of helping first, right? Clearly we're identifying clients and we're trying to pick them based on need, right? And we're saying we first of all need to communicate with every client and have them know that we're here, and we're trying our best to communicate the rule changes as rapidly as we can and help them and support them. And I feel the exact same way about how we're approaching business development. It's a help first mindset, which is how can I be here to help you through this process? What are the things that we're able to provide to you? So those would be the things that I would focus on. In terms of, I think it's difficult to answer that question without a little bit more color, right? We see companies and cities completely changing, right? You see restaurants that were traditional white table restaurants that are now offering, delivery and takeout. You see complete refurbishment of retail stores that are going into e-commerce. You see, so if you're providing a product, you've got to still find innovative ways to provide your product, right? If you're providing a service, you've got to find a way to deliver your service via, things like this, like Zoom, which is an extremely effective tool. You've got to continue to innovate. And if you're not able to sell your product because you're shut down, that's hugely problematic, but that's one of the key aspects of the PPP program and why it was established, is to help, get us over that hump to where you can get back to a new normal. But I also think this is a key time to evaluate the systems and processes that you do have in place to determine what's the low-hanging fruit that I need to fix when we get back, because you should theoretically be able to operate in some remote environment.
And I think, I think some of the cool things that will come out of this crisis is going to be around innovation. And I think it'll be innovation both in terms of technology, but also, innovation in people's business models and the way that you do go to market. We are seeing some clients, give an extended free, they're adding on time to this, a free trial for somebody who uses their services to make it more interesting. To the extent they have tiered sort of pricing products, they may be moving more functionality down into lower tiers to make that entry level price product more interesting. And so they are innovating on sort of their go-to-market and their business model side. And it's definitely a time for experimentation to see if you can figure out things that can work that you might not have tried in an environment where it was riskier to experiment.
So that's great advice. I think that's great advice. This is the time, if you are experimenting, and to an earlier conversation we had regarding venture capital a few weeks ago, KP Reddy from Shadow Ventures said something to the effect of, if you were a tech-enabled company that took VC capital and wanted to be a soft disruptor, now may be the time for you to actually be a disruptor and go back to your original business model to provide real solutions rather than be a middle person. He said something to that effect, and you can definitely go to CREtech's YouTube page for that CREtech Talks. But 100% agree with you guys on that. Another question came in regarding the again PPP. The application process for PPP isn't very helpful for startups. SBA lenders are asking for documentation based on 2019 instead of financial projections that are meaningful for startups. What SBA programs or other government-backed programs are helpful for startups and non-revenue firms?
Yeah. So first of all, I blame Dan mostly for that. As bad as, so, you know, you got two things here. You've got the PPP, which is available for the length of time that they were in business. So to the extent that they were paying salaries, they can calculate it either based on the 2019 figures, the most recent 12 months, which would include March, or the relevant period of time for which they were operating, right? So they've got three different ways to calculate in order to get the PPP. If they can't, I know it sounds kind of strange, but just with the news that I got about the EIDL, I mean, you know, an hour ago, literally the news came out. So if the EIDL program gets reestablished, that's an area where that could be a more interesting play for them, because they may not get a big loan because they might not have a lot of payroll. So if you're talking about a software company that has a lot of developers, 99s, they're not going to get any money to cover the cost to keep those developers employed. And if those developers apply on their own EIDL loan, or I'm sorry, a PPP loan, it's not as if they're going to give the company credit for that. So there lies where the company, in theory, go after the EIDL program, which is up to $2 million, as I had mentioned earlier, as the program is written, with a 30-year term. There's recent challenges as of an hour ago that the program is underfunded. Anything about the refurbishment of that fund and if it's going to be replenished, but that would be the consideration. In addition, there's some small state programs within New York, New Jersey, and other states. I'm more familiar with New York and New Jersey, for companies with fewer than 5 employees in New York, where you can get a grant up to $27,000 to cover certain payroll. There's also a program in New York for a $75,000 loan for operating businesses with fewer than 100 employees. Those would be things that I would look into as well. New Jersey has a grant program. It's fully expended for small companies with fewer than 5 employees, but they also have some loan guarantee programs and some matching loans up to $100,000. So I'd go to the New Jersey EDA website and look at those, or on New York, I would go to the NYC EDC website and take a look at them.
And then let's see, Dan or Joe, do you have anything to add to that? Or Matt, you did an awesome job on that. And I agree. I think for any of those, for any startups that are looking for advice, definitely check out your local EDC website for information. Another question came in from Jordan Lynchburg. Jordan, thank you for your question. If you are approved for the SBA EIDL program loan and the CARES Act PPP, can you draw from both programs if you use the PPP for payroll specifically and use the EIDL for other expenses?
This is maybe better. I don't know if Dan knows, like what I've learned is that the strategy here, the play here, is to secure the EIDL and then have the EIDL refinanced into a PPP loan, which will qualify for forgiveness potentially, depending on the use of the proceeds. And then there is strategy here, right, to think about though, because the EIDL carries a 30-year term, and that's very attractive for companies that have got a 30-year debt, right? On the other side, you've got the potential for forgiveness. So to the extent we know we're not going to have a piece forgiven, I like the EIDL loan better. To the extent we are going to get forgiveness, clearly the PPP is the way to go. So there is some strategy to be done here on the upfront on receiving a loan. There's also going to be significant strategy on the forgiveness piece, because something that we haven't spoken about is the way that the forgiveness is calculated. And so the forgiveness is calculated where the amount that can be used on other costs other than payroll is limited to 25% of the loan. So if you've got $1 million, you know, in terms of a total loan, and you use $750,000 of it to cover payroll, you can use $250,000 to cover things like rent, utilities, insurances, interest. So there's a play to potentially increase the amount of payroll to increase the allowances on the other covered cost side.
Joe, anything to add to that? Dan?
No, I would say, you know, for the venture capital backed tech companies, the EIDL program, I think people really haven't been focused too much on it. You know, going back to the sort of, should you apply for this loan, you know, the EIDL program has a much higher bar. You really have to sort of demonstrate kind of economic injury, economic damage. And so, you know, that plus I think the forgiveness piece sort of had people looking at the other program pretty early on.
Awesome. And then, so we have time for 2 more questions. New question just came in. It seems as though it's based on a new company with no employees. Is there any program for startups with multiple founding partners that haven't hired paid employees yet, but need substantial financial help to fund ongoing business operation and liabilities? So I guess to that, you know, Matt, you brought up the earlier point, you know, maybe definitely check out your local EDC for something like that, right?
Yeah. There's programs for fewer than 4 employees or fewer than 5 employees. The idle does carry more, obviously, than the PPP in terms of the requirements. So I don't know how they can show, they're going to have to show that they were demonstrably harmed, right? So it's a challenge for a company that never existed before to say we were harmed when we've really not got a comparative period to say we were harmed from. So I don't know what the SBA is going to use as a threshold. Maybe we could say, hey, in the month of January, we were able to do this, but now it's, you know, March and we can't for whatever reason. And so we are harmed, and that could be a path to application and approval. I'm not comfortable to say that would be the way that I would pursue it.
Yeah. And so let's end on a more optimistic theme here. Rapid fire or elaborate, whichever you choose. And I'll start with you, Dan, and Matt and Dan, and then Joe. What do you see coming out of the on the other end of this? Any industries you think will grow or benefit from?
Yeah. So first of all, and I'm going to do it quickly because I could talk for 3 hours on this. I like that what I'm calling this program is disguised unemployment, right? The other way we could have gone was to have all the companies that were harmed lay all these people off, the people, line up for unemployment. And then when we come out of this, which we will, we have to rehire that entire workforce, and that takes time, and that takes negotiation, and that takes effort. So I'm very hopeful that with the PPP program, keeping these people employed will allow us, the opportunity that once the country is ready to return, these people are already in our employ, and we're ready to go. As far as the industries, I think that this is always a time for innovation. I think we're going to see changed industries. We're going to see, there's going to be clear some losers in the near term in hospitality and restaurant. But we're also seeing new ways that they're able to deliver their service or their product. And so I'm hopeful that this is just going to be a changed economy.
And Dan, on the banking side, what do you see in terms of innovation and any optimistic outlook, outside of all this?
Yeah, for sure. First of all, real quickly, just remote access, remote connection is obviously a big winner, and those technologies already exist, but we're now really seeing that we can do this, right? You had 100 people on this program today, right? In terms of banking, believe it or not, I'm actually pretty bullish for online application and algorithmic lending and that type of thing. The last 2 weeks have been a complete disaster. We have not done a good job as an industry with this, but necessity is the mother of invention. And, we're all trying to build these programs these portals, to be able to deliver this program at scale. And while I would say we haven't done well as an industry, we're all now going to have this infrastructure, and it's going to be in place for when things do get to be more of a normalized environment. And I think that you're going to see more ingestion of applications and sort of, formulaic applications that are going to feed directly into underwriting models, and probably get more capital put to work, and probably give banks and other lenders more opportunity to explore loans sort of up and down a risk reward curve, versus I'd say typically we sort of make a decision on something's creditworthy and then figure out sort of how to price it and that type of thing. And I think that there's going to be more sort of elasticity in that as we look at applications, if we can handle the volume. So We haven't done great so far, but I think we're getting the infrastructure in place. It's actually going to help deliver on that in future years.
Joe,
yeah, I'll just add. Yeah, sorry, Ash. I would say I just add. I think sort of healthcare broadly, I think, can be a winner here. Certainly, telehealth, digital health. There are companies out there trying to think of new ways to deliver primary healthcare services. Those are potential winners here. I think in the real estate space, we're going to be using property in a fundamentally different way than we have before. Particularly, I think commercial property and how we go to the office and things like that. And I'm sure people on this call who are much smarter than me will figure out a way to use technology in a way to disrupt that, make that more efficient. So I, as I said earlier, I think that there is what comes on the other side of this. I think will be a ton of innovation that people will be benefiting from for a while.
And that's awesome. Right on the money. 1 hour exactly. So wow, guys, that was really incredible. So that's all the time we have for today's CREtech Talks. Thank you, Matt, Dan, and Joe. And of course, thank you to all of our amazing viewers and our amazing community members. Thanks for joining the conversation today. We hope you'll join us next week when we discuss M&A in real estate tech. And until then, see you guys next week. And thank you guys again. Have a great, great weekend.
Thank
you guys. Thanks, guys.
Be well.
Bye.